Hello everyone, welcome to the channel of Wall Street Mojo. Friends, today we are going to discuss a tutorial on payback period and discounted payback period. On the very first note, what do you mean by payback period and discounted payback period? See, when a business makes a capital investment like an investment on plant and machinery, building and land, etc., it incurs a cash outlay in expectation of the future benefits. The benefits generally extend beyond 1 year into the future. In this case, out of the different proposals available, the company has to choose a proposal that provides the best return and return equals or more than that is expected by the investor. In order to maximize the return of the shareholders of the company, it is very crucial that the best or the most profitable investment projects are selected. This is because the investment decisions which went bad can be both financially and strategically devastating. Now the below is Tesla Powerwall 2016 price number crunch and payback times. As you can see the details, the above article that notes that Tesla's Powerwall is not economically viable for most of the people. As per the assumption used in the article, Powerwall's payback range from 17 years to 26 years, considering that Tesla's warranty is only limited to 10 years and payback period higher than 10 years is not ideal. So like payback period, there are other number of other techniques that are available for the appraisal of the investments and proposals like NPV and IRR and profitable index, modified IRR, etc. However, in this particular article, we are going to look the payback period and the discounted payback period in detail. I'll show you one mind map, and based on that, you will be able to analyze where we are standing. As you can see, the investment decisions are based on traditional non-discounting and time-adjusted discounted cash flows. The non-discountings are based on payback period and accounting rate of returns. If you want to evaluate the time-adjusted discounted cash flows, then you can do that with the help of NPV, the net present value concept, or the profitable index, or IRR or modified IRR, or the discounted payback period. So whatever payback period you are able to find over here, you will just discount and you'll get the discounted payback period. So let's begin. What is payback period? The payback period of an investment is a length of a time period required for a cumulative total net cash flows to the total initial cash outlay. In other words, a payback period, the investor has recovered the money invested in the project. Let's see how the steps to calculate the payback period. The first step in calculating the payback period is determining the initial capital investment, and the next step is calculating the estimating the annual expected after-tax net cash flow over the useful life of the investment. So payback period calculation with uniform cash flows. This is a new concept. When cash flows are uniform over the useful life of the assets, then the calculation of the payback period is made through the following formula. The formula is the total payback, the payback period formula is equal to, you say, total initial capital investment, the total initial capital investments divide by, you will divide this whole thing by the expected annual after tax cash flow. Okay, you'll divide with the total initial capital investment divided by the expected annual after tax cash flow. Let us see an example of how to calculate the payback period when cash flows are uniform over using the life of the asset. Let's see the payback period example. Let's say a project is costing $2 million. So let's say the cost of the project is how much? $2 million. Okay, it yields the profit of let's say 30,000 after depreciation. Okay, make sure it is after depreciation. I'm just writing 2 million to my over here. Now the depreciation is, let's say, 10%, and but before taxes of 30%. Okay, so let's say the taxes are 30%. Okay, once you do that, let us calculate the payback period of the project. So let's see the answer. The answer is the profit before interest and tax. The profit before interest and tax is 30,000. Okay, less the taxes. So we'll do tax over here. We'll calculate the tax on this into 30%. Okay, you just have to go and punch the tax. So the resultant will be profit after tax, which is known as PAT. So 30,000 minus 9,000, that is 21,000. You will add depreciation to this. Okay, so I'm just writing depreciation to this, and depreciation is going to be 2 million into 10%. So you'll say 2 million into 10% is going to be our depreciation. So the total cash outflow, in this particular scenario is going to be PAT plus depreciation. That will be total 2,21,000. So while calculating cash flow inflow, generally depreciation is added back as it does not result into cash outflow. Payback period formula is total initial capital investment divided by the expected annual after-tax cash flow. So let's put this numbers in this particular formula just beside this, and let's see what is the answer. So the total capital investment is how much? 2 million. So I'm just writing 2 million. Okay, and expected annual after-tax cash flow is 2,21,000. So once you do this, you get the final answer as is equal to 2 million divided by 2,21,000. So the payback period is 9 years approx. Now the payback period calculation with non-uniform cash flows. When cash flows are not uniform over the full life of the asset, then the cumulative cash flow from the operation must be calculated for each year. In this case, the payback period shall be corresponding period when cumulative cash flow is equal to the initial cash outflow. In case the sum does not match, okay, then the period in which it lies should be identified. After that, we need to compute the fraction of the year that is needed to complete the payback. So let's take a payback period example. Suppose ABC company is analyzing a project which requires an investment again of let's say the investment is of 2 lakh. Okay, and it is expected to generate a cash flow as follow. Okay, this is the cash flow, annual cash flow. I'm just writing. This are the numbers: 80,000, 60,000. Okay, this is 1, 2, 3, and 4. This is number of years: 80,000, 60,000, 60,000, and 20,000. Okay, so these are the numbers. In this cash payback period can be computed as follow by calculating the cumulative cash flows. Okay, so the annual cash flow, so in this particular, this is the year. Okay, let's say this is the year and these are the annual cash flow. So the cumulative cash flow will be, I'm just writing cumulative will be is equal to 80,000 over here in the first year. The second year will be 80 plus 60 and so on. Okay, no, it's not doing the same thing. Plus 60, 60,000 plus 1 lakh 40 and 20,000 plus 2 lakhs. So it will be 2 lakh 20 is the final. Okay, so we can say in this particular third year, in this year we got initial investment of how much? 2 lakh. So this is the payback period. As you can see, our 2 lakh has got recovered in the third year. Okay, suppose in the above case, if the cash outflow is, let's say if this is, instead of this particular whole thing, if it had been 2 lakh 5,000, let's say this is 2 lakh 5,000. Here we got a direct answer that this is 3 years. But what about if the number is 2 lakh 5,000, something different? Then in that particular scenario, the payback period is between 3 and 4, as you can see, because 2 lakh 5,000 is between 2 lakh and 2 lakh 20,000, right? Since up to 3 years, a sum of 2 lakh is recovered, the balance amount of 5,000 will be recovered in the fraction of the year in which as follows. So for getting 20,000 additional cash flow, the project is taking to complete 12 months. So for getting additional 5,000, that is 2 lakh 5,000 less 2 lakh, 2 lakh 5,000 and 2 lakh. Okay, that is the difference. It will take, we have to recover that. I'm just saying that we have to recover what? We have to recover between 2 lakh 5,000 minus 2 lakh, which will be 5,000 is the difference. We have to recover from what? 20,000. 2 lakh minus 20,000, right? So 20,000, I will again write 2 lakh 20 less 2 lakh. So this is 5,000 we have to recover from 20,000. So 5,000 divided by 20,000, that will give us 0.25, right? So 3 years plus 0.25, that will be close enough to 3 years and 3 months. So the payback period is 3 years and 3 months. What are the advantages of the payback period method? It is easy to understand as it gives a quick estimate of the time needed for the company to get back the money it has invested in the project. Third, the length of the project payback period helps in estimating the project risk. The longer the payback period, the riskier the project is. So this is because the long-term predictions are less reliable. Fourth, in case of the industry where there is a high obsolescence risk like software industry or mobile phone industry, short payback period often becomes determining the factor of investment. Let's see some of the disadvantages of the payback period. First, it ignores the time value of money. Okay, it fails to consider the investment total profitability. That is, it considers cash flows from the initiation of the project till the payback period and fails to consider the cash flow after the payback period. Third, it may cause the company to place importance on the project which are short payback period. Thereby, it's ignoring the need to invest in long-term projects. That is, let's say a company cannot just determine a project feasibility only on the basis of the number of years in which it is going to give your return back. There are a number of other factors which it does not consider. Fourth, it does not take into account the social or environmental benefits into the calculation. Now, the payback reciprocal. This is the next concept. This is called payback reciprocal. The payback reciprocal is the reverse of the payback period. The reciprocal of the payback period is calculated by using the above formula that I'm going to evaluate. So, the payback reciprocal, I'm just saying PB and reciprocal. The payback reciprocal is going to be is equal to, we write as annual average cash flow, annual average cash flow divide by the initial investment. Okay, so this is going to be the formula. Now, for example, we'll take an example on this. A project is costing, let's say 20,000. Okay, and its annual cash flows are uniform. Let's say its annual cash flow is uniform, and that is 4,000 per annum, and the life of the asset is let's say 5 years. Okay, then the payback period reciprocal will be as follow. That is, we just have to put the numbers over here. Annual cash flow 4,000, initial investment 20,000, so a final answer will be is equal to 4,000 divided by 20,000. That will be 0.2, that is 20%. This 20% represents the rate of return the project or the investment gives every year. Okay, now let's understand the concept of discounted cash flow. Okay, discounted payback period. Discounted payback period is the next level of the payback period, where the cash flows are discounted before calculating the period of payback. Some companies prefer to calculate the payback periods as it considers the time value of money. The discounting can be done using the WACC, that is weighted average cost of capital, or IRR method, or bank rate. Company got the lending or government risk-free rate, bond rate. The most appropriate rate of discounted cash flows is by using weighted average cost of capital, which is also known as WACC. Let's take an example for calculating the discounted payback period. Okay, example number 1, discounted payback period. A project is having, let's say, a cash flow of cash outflow. Okay, a project is having let's say a cash outflow of 30,000. Okay, with the annual cash inflow of close enough to 6,000. Okay, so let us calculate the discounted payback period in this, assuming the WACC, that is the weighted average cost of capital, as we know is let's say 15%. If this is 15% and the life of the project is let's say 10 years. So how we are going to calculate? It's as simple as that. We just have to form year. Okay, we'll write 1 and then just go with the flow till 10. Then we have the cash flow, which is 6,000 for all 10 years. Control D. And then we'll do the present value at the rate of 15%. Okay, so we'll have all the present value 1 divided by 1.15, so you get the present value. So it will have all the relevant details over here, which I'll show you how it is calculated. And then the PV of the present value of the cash flow which will be, for an example, this is 870. Okay, so this will be 6,000 into 870, and we just need to do cumulative of this particular value, which will be is equal to this. Okay, for the first year it's going to be 5220. If over here I just make it 756, then the present value will be 6,000 into 756. This is just the present value factor. You need to calculate the discounted rate, and the present value of the cash flow is going to be cumulative. So in this fashion, you just need to go. You can just press Control D. I'll just write all the details: 658, 572, 497, 432. Then we have 376, 0.327, 0.284, and last is 0.247. So you can see the cumulative and everything is calculated. The whole table is calculated. In this case, the cumulative cash flow is 30,114 in the 10th year. So the payback period is approximately what? 10th year, because we have to recover the cash outflow. But if you calculate the same in the simple payback period, the payback period is going to be 30,000 divided by 6, the cash outflow divided by cash inflow. Okay, 6,000. That will give us 5 years. Please note that if the discounted rate increases, the distortion between the simple rate of return and the discounted payback return increases. Let me explain this further. Let us take 10% discounted rate in the above example and calculate the discounted payback period. We'll take what? Instead of 15%, we'll just take 10%. And if we take 10%, I just need to change a couple of details: 0.905, 0.826, 0.751, 0.683, 0.621, 0.564, 0.513, 0.466, 0.424, and 0.385. Automatically, all the details will change. It's just the game of a formula. So in this case, the discounted rate is 10%, then discounted payback period is close enough to how much? It's 8 years. Look at this. So with just decrease in the discount rate, the payback period has gone down. Okay, so the discounted rate is 10% and the discounted payback period is around 8 years, whereas the discounted payback period is 10 years if the discount rate initially that we had used was 15%. But simple payback period is 5 years. So in both the cases, this means that as the discount rate increases, the difference in the payback period, discounted pay period, and simple payback period increases. So the whole analysis that we can make, if the discount rate is 10 years, the simple payback is 5 years, the discounted payback is 8 years, and the difference in the payback period is 3 years, 8 minus 5. But if the discount rate is 15%, the simple payback period is 5 years, the discounted payback is 10 years, and the difference is 5 years. I hope you guys have got a reasonable understanding of what is discounted period and the discounted payback period. Let us take some more example to understand this concept better. Discounted payback period, we'll take example number 2. Let's say a company wants to replace its old semi-automatic machines with the new fully automatic machines, and in the market there are two models available in the market. Let's say model A and model B, okay, at a cost of 5 lakh. I'm just writing the numbers over here. Let's say the salvage value, I'm just writing over here, salvage value, let's say the salvage value is 1 lakh. Okay, the utilities of the existing machinery can be used in company purchase model A, and the additional utilities to be bought is only 1 lakh. So this is the additional utility, that is 1 lakh. However, in case of a company buys the model B, then all the existing utilities will have to be replaced and the new utilities of close enough to 2 lakh, and the salvage value of the old utilities is close enough to 20,000. Okay, so the cash flow is expected as follow. Let's say year 1, 2, 3, 4, and 5. So there are different cash flows of A and B. The cash flows are 1 lakh, 1 lakh 50, 1 lakh 80, and 2 lakh, 1 lakh 70. Control X and Control V. Okay, in the similar fashion, 2 lakh, 2 lakh 10, 1 lakh 80, and 1 lakh 70. Your last is 40,000. And here is the salvage value. The salvage value is 50,000 and 60,000. So this is the case. This is a very big example. Okay, I can show you. Let's say these are all the expenditure that have been incurred. Cost of machine 5 lakh, then the cost of utility 1 lakh, and so on and so forth. All other details have been given. Okay, so let's see how the calculation has been done. Okay, machine A and machine B, the present value factor of 15%, okay, the cash inflows, and the present value of this. So discounted value into the cash inflow, which will give us the present value of the cash inflow. This is, we have done the cumulative. In the similar fashion we have done for machine B. Once we do that, including the salvage value, in this case the discounted payback period for machine A is follow. Machine A is getting 4,33,800 at the end of Machine A is getting 4,33,800 at the end of the 4 years, and only 66,200 has to get into the year 5. So the payback period is 4.6. As we know, we have already calculated how to calculate this. I hope you have got it. So this discounted payback in both the cases same. Now how to calculate the cash flow for the payback period or the discounted payback period? See, generally the company use one or more techniques for capital investment decisions. Some of them use different methods for different projects, while others use multiple methods for each project. For any technique, the calculation of a projected cash flow is very important. Since the timing of the cash flow does not match with the period of the profit, normally firms are more interested in cash flows. A firm may earn 100 million profit, but actually cash receipts may be less. And this is because all the sales, purchase and sales are not on a cash basis. Further, depreciation is a very non-cash item, and the profit is calculated after considering the depreciation. Let's see the calculating of the payback cash flows. Various factors to keep in mind while arriving at the cash flows. The first one is depreciation. Since depreciation is a non-cash item, it does not affect the cash flow. However, the tax benefit from depreciation affects the cash flow. Okay. Second, opportunity cost. Opportunity cost is the income. Okay. Opportunity cost is the income that would have been earned or the cost that would have been incurred had the activity is done. For example, a company, let's say, has acquired a land of 10 million 5 years ago, and the cost of the land, if sold now, is let's say 25 million. Assume that if the company uses this land and now for the project, then its sales value will be 25 million, and it forms a part of the initial cash outflow. So the cost of the acquisition of the land 5 years ago at 10 million is irrelevant for decision making. Okay. Now, third, sunk cost. Sunk cost is the cost that is already spent, and hence it is irrelevant for the decision making. For example, if a company has paid, let's say, 50,000 for consultancy charge for preparation of the feasibility report, whether to take the project or not, in this case, the charges of 50,000 paid are completely irrelevant, as the sum has already been paid and shall not affect the decision whether the project should be undertaken or not. Fourth, working capital. Every project requires working capital to run the project. Therefore, while calculating the cash flows, the initial working capital should be treated as the cash outflow at the end of the project. Its release should be treated as a cash inflow. In case additional working capital is required during the life of a project, then the additional working capital required is treated as the cash outflow at that period of time. Fifth, allocated overheads. Some overheads are allocated based on the machine hours, labor hours, etc. They may be allocated to the new project as well. Since those expenses are already incurred and are just allocated, they should not be considered while calculating the cash flows. However, sometimes the overhead cost increases due to the acceptance of some project. Then in that case, the incremental overhead should be considered as cash outflow while calculating the cash flows. Sixth, additional capex. Generally, entire capital expenditure is not incurred only during the initial years. It may be incurred in the subsequent years as well. Absolutely, there's no doubt in that. In such cases, such cash outflow to be taken as outflow during those respective years. Seventh, exclusion of the finance cost. When cash flows relating to long-term funds have been calculated, the finance cost of the long-term fund should be excluded because of the WACC used for the discounted cash flow already taken into account the interest and the dividend payments. Eighth, post-tax cash flows. The cash flow should be taken the net of the taxes. It is always better to avoid using the pre-tax cash flows and pre-tax discounting rate. I hope you have understand how the cash flows and how to derive the payback and discounting payback period from those cash flows for the capital project. Thank you.